Want to know what a good, or even great, credit score is? Watch until the end of this video to find out. A credit score is a vital financial metric that provides a numerical assessment of an individual's creditworthiness. It serves as a reflection of their past credit behavior and helps lenders evaluate the risk associated with extending credit, otherwise known as lending money or a loan, to that individual. The credit score is derived from information in the individual's credit report, which includes details about their credit history, payment patterns, outstanding debts, and other financial obligations. If you find this video useful and would like to see more finance educational videos, please consider subscribing. For free shares with Trading 212, see the referral link in the description. Credit scores are typically generated by credit reporting agencies, such as Equifax, Experian, and TransUnion, using various scoring models. It's worth noting that global credit scores currently don't exist, so you can't transfer a US credit score overseas, and other countries might use their own scoring systems to determine creditworthiness. The most commonly used scoring model in the US, for example, is the FICO score, which ranges from 300 to 850, with a higher score indicating lower credit risk. In the UK, your credit score will be measured on a scale of 0 to 999 on Experian, or 0 to 1000 on Equifax. Lenders, including banks, credit card issuers, and mortgage lenders, rely on credit scores to assess an individual's creditworthiness when making lending decisions. A higher credit score generally translates to better borrowing terms, such as lower interest rates, higher credit limits, and more favorable loan terms. On the other hand, individuals with lower credit scores may face challenges in obtaining credit or may be subject to higher interest rates and stricter borrowing terms. The factors that contribute to a credit score can vary slightly depending on the scoring model used. However, common elements that influence credit scores include payment history, credit utilization ratio, length of credit history, types of credit accounts, and recent credit inquiries. Timely payment of debts, responsible use of credit, and maintaining a low credit utilization ratio are typically associated with higher credit scores. When assessing an individual's creditworthiness, lenders and other entities may perform credit searches or inquiries to gather information from credit reporting agencies. These credit inquiries can be categorized into two main types: hard inquiries and soft inquiries. Understanding the distinction between these inquiries is crucial, as they have different impacts on your credit score. A hard inquiry occurs when a potential lender or creditor requests your credit report as part of a credit application. Examples include applying for a new credit card, seeking a loan, or applying for a mortgage. Hard inquiries are typically initiated by the individual seeking credit. These inquiries become part of your credit history and are visible to other creditors who access your credit report. Hard inquiries can have a temporary negative impact on your credit score. Each hard inquiry typically deducts a few points from your score, although the impact may vary depending on the scoring model and individual circumstances. The reasoning behind this impact is that multiple hard inquiries within a short period may suggest a higher risk of credit overextension or financial distress. However, negative score impact is generally small and diminishes over time. Soft inquiries. A soft inquiry, also known as a soft pull, occurs when an individual or entity checks their own credit report or when a creditor performs a credit check that is not related to a credit application. Examples of soft inquiries include checking your own credit score, pre-approved credit offers, or background checks performed by employers. Soft inquiries do not impact your credit score. They are not visible to other lenders or creditors and have no bearing on your creditworthiness. Soft inquiries are typically used for informational purposes, such as personal credit monitoring or pre-screened credit offers, and they do not have any lasting effect on your credit history or score. Managing your credit inquiries responsibly is key to maintaining a healthy credit score. While hard inquiries have a slight impact on your score, it's generally advisable to limit the number of new credit applications within a short time frame. Multiple hard inquiries within a short period may signal a higher level of risk to potential lenders. On the other hand, soft inquiries have no impact on your credit score and can be performed without concern for negative consequences. Monitoring your credit report regularly and understanding the different types of credit inquiries can help you make informed decisions about when and how to apply for credit. By managing your credit responsibly and being mindful of the type and frequency of inquiries, you can maintain a strong credit score and increase your chances of obtaining favorable borrowing terms. Building and maintaining a good credit score is crucial for individuals as it can open doors to various financial opportunities. A high credit score not only improves the likelihood of loan approval but also enables access to competitive interest rates on credit cards, mortgages, and auto loans. It can also positively impact other aspects of personal finance, such as insurance premiums, rental applications, and even employment prospects. To improve or maintain a good credit score, individuals should make payments on time, keep credit card balances low, avoid opening unnecessary credit accounts, and regularly monitor their credit reports for inaccuracies. It's essential to establish responsible credit habits early on and maintain them consistently to build a strong credit history over time. It's important to note that lenders will all have different methods of assessing credit eligibility, and the credit score is only one of many factors they use as upper part of their eligibility calculation. Because of this, whilst one lender may not be willing to provide credit to an individual, another may be happy to. That's why it's important to use comparison websites like moneysupermarket.com and comparethemarket.com. These comparison sites offer consumers a centralized platform to efficiently compare a wide range of financial products, saving time and enabling cost savings. These websites provide transparency, choice, and user reviews, empowering users to make informed decisions based on their personal needs and preferences. Importantly, they also highlight which services you may be pre-approved for, or services which you are not eligible for. However, it's essential to conduct additional research and review specific terms before finalizing any choices. So, what is considered a good credit score? In the UK, anything above 881 on Experian, or above 420 on Equifax, is considered to be a good score. In the US, FICO scores in the 740 to 799 range are deemed very good, and scores between 670 to 739 are good. Individuals with scores in these ranges may qualify for better interest rates from lenders.